Hey everyone, this is Kirk here again at Option Alpha, and in this video tutorial we're going to cover bullish flag chart patterns. So let's get into it here as always. So the actual pattern itself is pretty easy to spot on most charts, and in fact it's become one of the favorites for most technical traders and chartists. And the pattern really is this. It looks like a flag that's waving off of a flagpole, and that's where it gets its name. So we have a sharp steep increase into the pattern, and then we have some consolidation in a channel that is going against the major trend. So if we have a bullish pattern like we have here, we'd have a sharp run up in the stock and then a channel which is going in the opposite direction, or a downward sloping channel. And then after the downward sloping channel we have a breakout, and the pattern continues to run higher and higher. So for me, I always say that flags are the rest stop type continuation patterns. So they mark an area of small consolidation in a bigger, broad, more powerful trend. The most important point about these these chart patterns, is that we have a sharp advance with heavy volume at the beginning of the pattern, and that's really the key here with flags. For them to be important flags, I always say the higher and tighter the best. So if they're a high, very tight, very consolidated pattern, and then they break out, those are the best. If it's kind of loosey-goosey in here and it doesn't really look like a pattern, you got to kind of stretch your trend lines and make up stuff to make it look like a flag, then it's not so much a really good flag pattern to trade. Let's get into the numbers here as we always do. The average rise or decline from these patterns is about 69%. So like I said, this is a very powerful pattern. Now this is a little bit subjective because we're looking for historically patterns that fit all the criteria. So again, if you have one of those high and tight patterns that are very, very consolidated, very close together, you have a higher likelihood of seeing these types of returns after the breakout. If it's kind of loosey-goosey, then the numbers also get loosey-goosey as well. The returns aren't as great after the breakout. But generally speaking, 69% as far as an average rise from the breakout is very, very solid gain. So a very good pattern to look for. The breakout failure rate, same thing. It goes more or less with our talk here about this, about 4% failure. So once we see an already established strong trend in the beginning, the likelihood that it's going to fail at the first sign of weakness is pretty small. So these patterns have a low failure rate, which is really good for traders. So if you do happen to catch one in the middle of a trend, you know that you can put some good money towards it. The throwback or pullback rate is about 54%, and so basically what this is talking about, as I always mention here, and I've even put this on this chart, is that after the breakout, it's got about a 54% chance it's going to come down at least halfway of the move. Sometimes it comes all the way down and retests this declining trend line, but it's going to retest some area of support and just validate and reconfirm that there are buyers in the market. So we've seen a breakout, we've seen an influx of buyers, and now it's going to sell off a little bit. Those first couple buyers are going to sell their shares, but it's going to want to see that more buyers are interested in coming back into the security, which is going to launch it higher. So like I always tell people with my coaching sessions on one-on-one coaching, the pullback or throwback is usually the best time to get in. Wait for the breakout and then grab some shares or grab some option trades after the pullback and reconfirmation of the new support level. So some keys to remember with this pattern. Again, with flags, prices run parallel. They run in a parallel channel downward. This is very different than pennants. A lot of people get pennants and flags confused. In pennants, the prices converge and they form what looks to be a pennant or small type of triangle pattern. Number two is that you need to see a sharp spike in volume towards the end of the pattern. This is really important here, and I'll actually go back and show you that, as you can see here, that right before the breakout, we actually don't get a full retest of the prior support level. So you can see throughout the pattern, the market is testing lows and highs and support levels, but right before the breakout, we actually don't come all the way down as far as we should. We actually are kind of even with the prior low. And what you want to see is a sharp volume spike right here. You want to see more buyers getting really interested and kind of anticipating this breakout type happening. And then third, the price target after the breakout is measured from the beginning of the prior trends move to the top of the consolidation region. This is generally called the flagpole, and this is usually what people refer to as a flagpole type move. But basically what we're talking about here, if I go back, is that from the base in the beginning of the move all the way to the top of the first area of consolidation, you can measure that same distance from the breakout to whatever that point is on the chart, and that's usually what your price target is going to be. It's going to make about the same move that it made before it started to consolidate, which is why I call it the rest stop. It's just kind of stopping halfway in the middle point of a powerful trend and then continuing to move higher. Hey, thanks for watching this video from Option Alpha. As always, we invite you guys to come back and check us out at optionalpha.com. And if you like this video, please share the video with any of your friends, family, or colleagues on your favorite social network.